Silver just did something most people thought was impossible. Silver has now crashed all the way down to $75, marking one of the most brutal sell-offs in modern precious metals history. From the highs, we're talking about a collapse that wiped out trillions in paper market value, crushed leveraged traders, and sent shockwaves through gold, crypto, equities, everything. Gold didn't escape either. Gold got hit hard, losing momentum, breaking key technical levels, and confirming that this wasn't just a silver event. This was a system-wide liquidation. So the question everyone is asking right now is simple. How does a so-called safe haven collapse this violently? Who is behind it? Who profits from it? And what happens next from here? Because what just happened is not normal price discovery. This is not the market voting. This is structure breaking under stress. Let's break it all down. What just happened? The crash to $75 silver collapsing to $75 wasn't a slow grind. It wasn't organic selling. It was a waterfall event. Once silver lost the 95 zone, it was game over for the short term. That level was the last major line of defense. When it snapped, margin calls started firing everywhere. Stops got run. Forced selling kicked in. Liquidity vanished. This wasn't retail panic. This was leveraged paper positions getting vaporized. And remember, silver is one of the most heavily leveraged commodities on Earth. For every ounce of physical silver, there are hundreds of paper claims floating around in futures, options, ETFs, swaps, and unallocated accounts. When price starts moving fast, that leverage works both ways. On the way up, it's explosive. On the way down, it's deadly. Once silver cracked below $90, the algos took over. Below $86, liquidation became unavoidable. And when $80 failed, it was pure air pocket straight to $75. That's not price discovery. That's forced liquidation. Why did gold and silver crash together? People always say gold and silver are safe havens. And long-term, they are. But short-term, they are still financial assets trapped inside a leveraged system. When liquidity dries up, everything gets sold. Here's what triggered it: rising real yields, strong dollar pressure, risk-off across equities, crypto getting crushed, tightening global liquidity, and most importantly, massive over-leveraging. When big funds need cash, they don't sell what they hate. They sell what they can. Gold and silver are liquid, so they get dumped. This is exactly what happened in March 2020. Gold crashed right along with stocks, not because it failed, but because it was used as collateral. This move to $75 was the same playbook, just bigger. Who is involved in this move? Let's be very clear here. This wasn't caused by retail investors. This wasn't caused by stackers. This wasn't caused by people buying coins. This move was driven by bullion banks, large hedge funds, market makers, central bank-adjacent institutions, highly leveraged futures traders. The paper silver market is dominated by a handful of massive players. They control liquidity. They control positioning. And most importantly, they control when forced selling happens. When volatility spikes, those players don't panic. They plan. They know exactly where margin calls hit. They know where stops are clustered. They know which levels cause cascading liquidations. And when those levels break, they step aside and let the market fall into a vacuum. How the banks profited from this crash. This is the part most people don't understand. Banks don't lose in crashes like this. They feed on them. Here's how they made money. Short positions banks were heavily short silver into this breakdown. As price collapsed, those shorts paid out massively. Forced liquidations. When traders get margin called, their positions are liquidated at market prices. Banks are on the other side of those trades. Volatility expansion options premiums explode during crashes. Banks sell volatility. They collect premiums while retail gets wrecked. Physical accumulation. This is the quiet part. While paper price collapses, physical silver is quietly absorbed off market, especially in Asia and the Middle East. Paper goes down. Physical disappears. Paper price versus physical reality. Here's the disconnect nobody can ignore anymore. Even with silver at $75 on COMEX, physical silver premiums are not collapsing. In many regions, they're rising. Dealers aren't dumping inventory. Mints aren't slashing prices. Delivery delays are still present. That tells you everything. This crash is happening in paper space, not physical space. The futures market says silver is cheap. The real world says silver is scarce. That divergence can't last forever. Gold-silver ratio just went parabolic at $75 silver. The gold-silver ratio has blown out to extreme levels not seen in generations. Historically, when this ratio stretches this far, one thing always happens next. Silver violently outperforms gold on the rebound every single time. The wider the stretch, the more violent the snapback. This move didn't fix the imbalance, it made it worse. Why this crash had to happen? Here's the uncomfortable truth. This crash was necessary. The silver market was too leveraged, too many weak hands, too much paper exposure, too many people trading silver like a meme asset. The system needed to flush leverage. That's what $75 did. It wiped out over-leveraged longs reset positioning, transferred metal from weak hands to strong hands, and cleared the runway for the next move. Markets don't go straight up. They break people first. What happens next? The road ahead. Now comes the part everyone cares about. Here are the realistic scenarios from here. Scenario 1. Base and rebound silver builds a base between $70–$80. Volatility cools, shorts take profits, price grinds higher. Scenario 2. One final flush a panic wick lower into the high 60s before snapping back violently. This would mirror historic silver bottoms. Scenario 3. Policy catalyst. Central bank pivot, Fed shift, or liquidity event sends metals ripping higher fast. Silver moves faster than gold, as always. What is not likely? A slow death to zero, a collapse in physical demand, a permanent suppression at $75. Those narratives don't line up with reality. Why banks need silver low? For now, banks need silver low for 3 reasons: to cover shorts cheaply, to accumulate physical quietly, to maintain confidence in fiat markets. Silver screaming higher exposes currency weakness. That's why it's always managed aggressively. But management doesn't mean control forever. It means delay. The big picture. This changes nothing long term. Let's zoom out. Governments are drowning in debt. Fiat currencies are losing purchasing power. Central banks can't normalize without breaking the system. Physical metal inventories are shrinking. A paper crash does not fix those problems. It just resets positioning. Silver at $75 doesn't mean silver failed. It means the paper market broke again. Final thoughts. Read this carefully. This move destroyed traders. It punished leverage. It rewarded patience. If you were trading this with leverage, you felt real pain. If you were stacking physical with conviction, this is just noise. The biggest silver moves in history always start after crashes like this, not before. Capitulation comes first. Disbelief comes second. Then the real move begins. Stay disciplined. Understand the risks. Don't confuse paper volatility with physical reality. This market is resetting, not ending.